Welcome to the Deep Dive. Today, we're taking a close look at Omnicom Group's second quarter 2025 earnings call. You know, Omnicom, that global leader in advertising, media buying, all things marketing services.
Indeed, a big player.
Exactly. And this deep dive is all about getting you the key insights from that call. The market definitely reacted positively. Shares got a nice lift after the release.
Yeah, there was a definite sense of relief, I think. Investors liked the top-line story.
Okay, so let's unpack this then. What were the top-line numbers that got people feeling reassured?
Well, they really delivered a solid beat this quarter. Revenue hit $4.02 billion, which was, quite a bit better than the street expected.
Okay.
And their adjusted EPS, that came in at $2.05, also nicely above expectations.
And organic growth, that's always key.
Right, that landed at 3%, solid. And importantly, right in line with what management had guided for.
Good.
Now, the operating margin, that did dip slightly, down to 10.9%. They mentioned a mix shift and some integration costs playing into that.
Right, the IPG deal costs starting to flow through, maybe.
Partially that and some other repositioning. But the main takeaway was really that top-line resilience.
Yeah, that resilience is definitely the headline, especially, considering the first half was pretty tough for the whole agency sector.
Absolutely. So for Omnicom to post these numbers and maintain their guidance, it definitely calmed some nerves.
So, okay, let's get into the weeds a bit. Where did that 3% organic growth actually come from? It wasn't uniform, I take it.
No, definitely not uniform. It's quite interesting when you break it down. Media and advertising was the real star performer, up a strong 8%.
Wow, 8%. That's significant.
It is. And precision marketing, also healthy growth there, 5%.
Okay.
But then you had areas facing headwinds. Public relations was down 9%. They mentioned some tough comparisons versus election spending last year, plus some network weakness.
Right, comps can be tricky.
Yeah, and healthcare was down 5%. That was partly due to losing a large client compared to last year and some brands nearing patent expiration, winding down work. But they do expect that to improve.
Okay, so specific factors there.
Exactly. And the biggest drop was branding and retail commerce, down 17%. That really felt the impact of the macro uncertainty and the slowdown in M&A activity.
Yeah, branding can be quite cyclical with M&A and geographically.
Growth across the board, actually, except for the UK. And the crucial U.S. market, that grew a solid 3%.
Okay, so managing through a pretty mixed environment there. How did they handle expenses against that backdrop? What about profitability and cash flow?
Yeah, they seem quite disciplined on the expense side. Salary costs, their biggest line item, actually decreased as a percentage of revenue. So efficiency initiatives are paying off.
That's good to see.
And the adjusted EBITDA margin, non-GAAP, was flat year over year, 15.3%. Stale.
Despite the headwinds. Okay, but you mentioned integration costs.
Right. Important point. They did book significant costs in Q2, $66 million for acquisition-related expenses,
Right.
mostly the IPG deal, regulatory stuff, planning, and another $89 million in repositioning costs, sort of optimizing existing Omnicom units.
So nearly $150 million in one-offs.
Pretty much. But they were clear. These costs are factored into their full-year margin guidance. So no surprises there, hopefully.
Okay, that's reassuring. And the cash flow picture, how are they using their cash?
Well, free cash flow itself was down year over year, but they did point to better working capital management, using operating capital more efficiently.
And deployment, dividends, buybacks.
Yep, the usual suspects. Dividends, share repurchases, they're targeting $600 million for the year. Interestingly, management sort of hinted they'd buy back even more, if not for certain agreements.
Oh, suggesting they think the stock's cheap.
That's certainly the implication, yeah. And they're also investing strategically in tech platforms, so CapEx is a bit higher than usual.
And the balance sheet overall, debt.
Still looks strong. Debt's manageable at $6.3 billion. They've got plenty of liquidity, about $3.3 billion cash, plus an undrawn credit facility. Returns on capital and equity are very healthy too, 18% and 34% respectively.
Okay, so financials look pretty well managed. Let's pivot to the big strategic stuff. The Interpublic acquisition you mentioned, costs flowing through, but what's the latest on getting that deal actually closed?
It's definitely moving ahead. Big news in June was getting the U.S. antitrust approval. That's a major hurdle cleared.
Huge.
Yeah, so now they're at 13 approvals out of the 18 jurisdictions they need. They sound very confident about closing it in the second half of this year, still on track.
And the synergies, that $750 million target.
They're sticking firmly to that number.
Yeah.
And actually, they're actively looking for ways to potentially exceed it. They're already working on integration planning, even reorganizing parts of Omnicom now so they can hit the ground running the moment the deal closes.
Proactive. I like that. Sort of preparing the ground before the merger even happens.
Exactly. It's about ensuring a smooth transition and capturing those benefits fast. Seems like a smart way to minimize disruption.
Okay, and speaking of being proactive and strategic, let's talk AI.
Yeah.
The Omniplatform.
Uh-huh.
How are they really using AI to, stand?
This is a huge focus area for them. They've actually restructured pulling together Omni AI, ArtBot, Flywheel Commerce Cloud into one big end-to-end platform organization.
Centralizing the tech power.
Right, and this whole platform is going to get a massive boost from the IPG deal, adding IPG's Kineso and Axiom data platforms, plus their real identity solution.
So combining the data and tech firepower of both companies.
Precisely. And their CTO talked about how they're using generative AI. They've moved beyond just like basic content creation. They're talking about an agentic framework.
Agentic framework. Sounds fancy. What does that actually mean?
Think of it like having multiple specialized AI agents working together on a campaign. The one analyzes data, another optimizes the strategy, another helps refine the creative. They collaborate across the whole process.
Okay, so like an AI task force for each campaign. Can you give an example?
Sure. They mentioned using synthetic audience agents, basically AI personas based on their Omni data. They could use these to run synthetic focus groups really quickly, test ideas, personalize content, stuff that used to take weeks, now done in minutes.
Wow, okay. Speeding things up dramatically.
Exactly. And in healthcare, they have a multi-agent engine that helps adjust campaigns faster if market conditions shift. For digital commerce, agents help with new product launches, finding insights from sales data, competitor moves.
So it's not just efficiency, it's about smarter, faster strategy and creative.
That's the core idea. It's about building differentiated capabilities, exploring more creative options, and ultimately strengthening their competitive edge long term. It's AI as a strategic partner, not just a tool.
Okay, that makes sense. So putting this all together, the solid results, the IPG deal progressing, the AI strategy, what's the outlook for the rest of the year? What's management saying?
They reiterated their confidence, sticking to the full-year organic growth guidance at 2.5% to 4.5% range, and also their adjusted EBITDA margin target, aiming for 10 basis points higher than 2024.
So steady as she goes, despite the macro environment.
Pretty much.
Yeah.
The CEO acknowledged the uncertainty, especially, things like tariff discussions out of Washington. But he said the overall environment hasn't really changed dramatically since April, and their big clients are long-term partners, so implying stability in spending.
Did they address the competitive landscape? We sometimes hear about pitch pipelines shrinking.
Yeah, they pushed back on that idea, said they're invited to every significant pitch, and are actually seeing some unusual activity even over the summer, which is normally quieter.
Interesting. And what about that idea of AI leading to clients spending less because of efficiencies?
Ah, yes. They have a fascinating take on that. They believe the efficiencies clients gain from AI won't lead to budget cuts. Instead, clients will reinvest those savings back into their brands, pushing for more marketing impact.
A virtuous cycle then. AI saves money, which funds more marketing.
Exactly. They call it enabling mass personalization at scale. Better targeting, better results, justifying more investment. That's the thesis. They also kind of brushed off concerns about potential changes to healthcare ad regulations. Yeah. Basically saying it's mostly noise right now.
Okay. So for investors listening, pulling back from the details for a second, why was this quarter's update so well received? What was the bigger picture context?
Well, you really have to look at where the stock was. Omnicom shares had dropped, over 30% since the peak last October?
Right. It had been a rough ride.
Yeah, driven by fears about the ad cycle, rising interest rates hitting valuations, and definitely the uncertainty around getting the IPG deal approved by regulators. Short interest had picked up 2 more people betting against the stock.
So the market was kind of pricing in bad news.
Seems like it. There was some volatility recently, too. So this earnings report, with the revenue beat and the steady guidance, especially the progress on the IPG deal, acted as a real positive catalyst, the first significant one in maybe 6 months.
A relief rally, essentially. Did it lift other boats in the sector?
It did. Peers like WPP and Publicis saw a bit of a lift, too. Interestingly, Interpublic itself lagged a bit.
Why is that, if the deal is moving forward?
Likely due to what they call deal spread worries. Basically, uncertainty among IPG investors about the exact value or timing they'll receive when the deal closes. It creates a bit of a discount until it's finalized.
Got it. So the main investor buzz was really around the IPG synergies becoming more tangible and client spending holding up.
Absolutely. It validated Omnicom's strategy and suggested maybe the worst of the macro fears, for them at least, were overblown.
All right, that sets the stage perfectly. It's time for our This Is Not Financial Advice segment. Based on today's call, what's an outrageous but plausible trade idea straight from the hedge fund playbook?
Okay, here's one, playing directly off that dynamic we just discussed. A long Omnicom, OMC, short Interpublic IPG pair trade.
Ooh, interesting. Long the acquirer, short the target. Explain the thinking.
Right. So Omnicom's call showed strong execution, clear progress on the IPG deal, high confidence in synergies, regulatory hurdles being cleared, hints at maybe more buybacks, signs of operational strength and confidence in their own value.
Okay.
Interpublic, meanwhile, lagged in the market reaction, right? Suggesting that deal spread concern is weighing on the stock. There's a perceived discount or risk there relative to Omnicom.
So the trade assumes Omnicom continues to execute well and the deal closes as expected.
Exactly. The outrageous part is betting against half of a seemingly on-track merger. But the plausible rationale is that Omnicom's operational momentum and proactive integration planning give OMC stock more upside potential before the deal closes. IPG stock might remain somewhat constrained by the deal mechanics, and that spread until the ink is dry.
So you're capturing Omnicom's perceived strength relative to IPG's deal-related lag.
That's the idea. You profit if Omnicom outperforms Interpublic between now and the deal closing, leveraging Omnicom's demonstrated strength and the eventual resolution of that deal spread uncertainty.
A classic pair trade structure exploiting perceived relative value. Okay, makes sense within the segment's theme.
Definitely fits the outrageous but plausible bill, I think.
All right, let's wrap up this deep dive then. Key takeaways. Omnicom put up a solid Q2, showed resilience on the top line, which was crucial.
And real momentum strategically, both on getting that big Interpublic deal closer to the finish line and pushing forward with their AI-driven Omniplatform.
Yeah, the overall feeling seems pretty positive about their ability to handle the macro stuff and drive growth through the IPG integration and that tech innovation.
Agreed.
Okay, just our usual friendly reminder, anything we've discussed here on the deep dive is strictly for informational and entertainment purposes. It is absolutely not financial advice. Please always do your own research.
And maybe something to think about as you do that research. With AI changing things so fast, how will the ad industry really start measuring and compensating based on actual business outcomes for clients, rather than just effort or media spend? And what could that unlock for brands?
A fundamental shift to consider. Great food for thought. Thanks for listening to The Deep Dive.